Welcome to The Explainer. Today we're opening up the books on a fascinating, highly cyclical industrial giant, HEG Ltd. We're going to dive into the raw data, the fundamentals, and honestly, the wild financial history of this company. Just a quick heads up before we jump in, this is purely for educational purposes, to help you understand the source material. We're simply unpacking the data here, so no financial advice, just facts.
Okay, to really get HEG, we first have to ask, what is the hidden engine behind the global steel industry? Like, what powers every single electric arc furnace on the planet? It's this critical, highly specialized consumable component. It's absolutely essential for modern steel manufacturing, but almost nobody talks about it in the mainstream. Literally, without this piece, the electric arc route to making steel just grinds to a halt.
Well, that missing puzzle piece is the graphite electrode. Think of them as high-tech consumables, produced in ultra-high power, and super high power grades, depending on exactly what a steel manufacturer needs. And what's wild about this space is the massive barrier to entry. Get this, HEG was literally the most recent global entrant into this industry, and that happened all the way back in 1976. Yeah, nobody is exactly rushing in to compete here, because the manufacturing process is incredibly capital and tech-intensive.
Okay, let's dive into this, because their scale is massive. We're talking 100,000 tons per annum. Their facility in Madhya Pradesh isn't just big, it's the largest single-site integrated graphite electrodes plant in the entire world. And when you're running a power-hungry manufacturing process like that, you can't just plug into the local grid. So they run on their own 80-megawatt captive power generation split across 2 thermal plants and a hydropower plant. Talk about self-reliant.
When you break down their FY24 sales, it's super clear that HEG is fundamentally an export powerhouse. Only 33% of their sales are domestic, while a massive 67% of their output gets shipped overseas. We're talking exports to over 35 countries, supplying a significant chunk of their production directly to the top 20 global steel companies. They are deeply, deeply embedded in the global supply chain.
Section 1. Growth and Evolution.
You know, a company doesn't survive in heavy industry by just standing still. Backed by the L&J Billwara Group, HEG is pushing forward hard. Following their recent moves tells quite a story. Back in November 2023, they knocked out a massive 1,200 crore rupee capacity expansion. That's what pushed them to that 100,000 tons mark and made them the 3rd largest producer in the Western world. Then, May 2024 hits, and they announce a major structural shakeup, a demerger of the graphite business into HEG Graphite Ltd. And a merger with Billwara Energy Ltd. But actually, the most fascinating part is slated for FY26, a brand new 20,000-ton graphite anode plant. They're pivoting straight into battery materials.
And that pivot into advanced materials, it's already happening quietly in the background. Their wholly owned subsidiary, TACC Limited, is actively developing synthetic graphite and graphene derivatives. They aren't going at it alone either. They're partnering up with heavyweights like Burla Cellulose for graphene-enhanced textiles, and they've inked deals with Ceylon Graphene Technologies to co-produce graphene using high-quality vein graphite from Sri Lanka. It's a seriously high-tech side hustle to their main heavy industry operations.
Section 2. The Financial Roller Coaster.
Now, all of this growth has to be looked at through the lens of their market reality. Because HEG is a commodity-linked stock, its financial performance is tied directly to global steel demand and electrode pricing, which means dramatic, highly cyclical financial swings. Definitely not for the faint of heart. To set a baseline, the company boasts a market cap of 12,683 crore rupees. The stock's PE ratio sits at 35.8, which is actually a bit below the industry average of 37.6. Current market price was 657 rupees, with a book value of 247 rupees and a total debt load of 796 crore rupees. On paper, looks like a really sturdy, well-capitalized industrial firm. But you really have to look at the history to understand just how volatile this gets. During the electrode supercycle in FY19, HEG posted a mind-blowing 3,026 crore rupee net profit. The EPS was an insane 156.80 rupees, but just 2 years later, the FY21 market crash hits, and poof, that massive profit totally vanished, flipping into a painful 18 crore rupee net loss. That's the reality of a cyclical commodity business. The peaks are out of this world, but the valleys are incredibly deep.
And this roller coaster isn't ancient history. It's happening right now in their quarterly numbers.
Just recently, they swung from a massive negative 148 crore rupee operating profit, which was a brutal negative 25% margin, right back up to a positive 151 crore rupee operating profit with a 22% margin in the very next quarter, ending June 2026. A couple of bad months can totally wipe out margins, but the recovery can be just as violently sharp.
Section 3. Who owns the stock?
Now, what's really interesting about this is, with all of this extreme volatility, who is actually braving these swings? Well, it's the core insiders. Out of roughly 1.39 lakh shareholders in June 2026, the promoters hold absolute dominance with 56.27% of the company. The public holds about 26%, while domestic and foreign institutional investors sit at about 9% and 8.5% respectively. The folks running the show have serious skin in the game.
And tracking that trend over the last 3 years shows a really clear pattern. Promoters haven't just been holding, they've been quietly adding to their stake. Usually that's a big signal of internal confidence. Meanwhile, the foreign institutional investors are trading in actively, jumping in and out to catch those cyclical swings. And domestic institutional investors, they've generally been net reducers, slowly trimming their positions over time. Section 4. How HEG matches up.
So it's one thing to look at HEG in a vacuum, but how do they survive these swings compared to their direct rivals? The contrast is pretty stark. While HEG recently posted a positive 122.34 crore quarterly net profit, which is a nice 22.57% quarter-on-quarter jump, their competitors are actively bleeding. Graphite India, a 105 crore rupee loss. RHI Magnesita, a massive 518 crore rupee loss. Right now, HEG holds the highest trailing 12-month net profit in this whole peer group, proving they're navigating this current cycle better than most.
Weighing the fundamental takeaways, on the pro side, HEG pays a really healthy dividend of 25.8%, which is great for rewarding investors who hold through the volatility. But the cons are definitely there. The stock is trading at 2.67 times its book value, meaning the market is pricing it at almost triple its actual net asset worth. Plus, long-term profitability has shrunk, shown by a low 3-year return on equity of just 5.73%. And here's the kicker. A massive 432 crore chunk of their trailing 12-month profit is from other income, meaning it's not actually coming from their core electrode business.
Which brings us to our final pivotal question. We've seen the incredible peaks and the painful valleys of their traditional steel-linked business. But looking forward, will HEG's ambitious corporate restructuring and their big tech pivot into battery anodes and graphene finally smooth out this wild historical earnings cycle? It's an absolutely fascinating transformation from a traditional heavy industry player into an advanced materials company. I highly encourage you to dive deeper into the data on your own. Thanks so much for joining us on this deep dive on The Explainer.